So today I wanted to make a video about the biggest mistakes that I believe new investors make. I think it kind of depends, but I think that there's a lot of them. Um, and I think that this is a new thing, and I think it's different than in the past because number one, investing is easier than ever. I mean, that's, I guess I'll touch on the first mistake that people make. And the first mistake is not doing it at all, right? I mean, the amount of people out there that don't do it at all is frankly astounding. So that's the first mistake. And anyone, who, even if you're making mistakes, I guess technically it's better than not even doing it at all. Although to be fair, a lot of people are losing money and will keep losing money. But that's the first mistake. But I think that people make a variety of mistakes. The first one I think that I see a lot is people who just blindly index. And I'm going to make a specific video on why I believe that that's not a great idea. But at the end of the day, I think it's because I don't think it's going to be hard to beat the market over the next 10 or 20 years for starters. And number two, um, the problem being, I guess, to go briefly into it, is blindly indexing. Again, like, why just blindly index, right? I mean, if you're going to do investing yourself, why not put a little bit more effort into it so you can get more results, right? I think that that's a common mistake I see. Um, the next and biggest one I see is people taking unnecessary risk, and that's, you have stocks like Tesla, right? In that people have massive amounts of their money in these very risky. Again, I think Tesla is a decent company. The problem is that they're very overvalued, like I talked about in my last video. And on top of that, we have even worse companies, like significantly worse, like the tattooed chefs of the world that are losing money. They're not even really growing all that much. They're like, everything about them is bad, right? Literally everything. They are perpetually increasing shares to stay afloat. So the first mistake is investing in companies that are losing money and or are very expensive, right? That is the first mistake I think people make. Is, again, just because a company's growing doesn't mean a whole lot. I mean, that's what you want in a good company, but it's not the only thing, right? Obviously, you want a company that's growing, but you also want to say, am I buying this business for a fair price, right? Because if you have two companies in the same industry, one of them has a price to fee, let's just say all other things being equal, one has a price to free cash flow of 50, the next one is 20. Obviously, the one that's a 20 is a screaming deal compared to the one that's 50. But again, people just don't put that stuff together for whatever reason, right? So that's the first thing too, is that you need to make sure, number one, buying companies that don't make money is insanely risky, right? The tattooed chefs of the world, Peloton, a lot of the ARC stocks, again, very, very, very risky. And in my opinion, it's unnecessary risk, because if you're going to take risk, you want to take it in places where there's actually upside, right? Bitcoin, I believe, is the perfect example of that because, well, frankly, there's unlimited upside. I mean, this is something that's gone up, what, 100% per year since inception. Like, Tesla doesn't even touch that, right? Go back, 10 years. Tesla's grown amazingly well, but again, compared to Bitcoin, it's child's play, right? And again, I don't think Bitcoin's going to grow nearly as much as over the next 10 years as the last 10 years, but I think it's still going to easily beat the market, right? Again, my opinion, and everything here, my opinion, obviously. And then what are some other mistakes? People trying to day trade, and like day trading crypto, all of these just needless things, right? And I'll give you a point to back up what I'm trying to say, right? If we took the top 100 most successful investors, or even the top 1,000, what percentage of those are people that are day trading? My guess is that it's none of them, right? Maybe a very small percentage, but my guess is that it's probably none of them, right? The people that make the most money in investing are people who I mean, it's one of three things, right? It's um, real estate, which is hard for the average person to make a lot of money because Not that it's impossible, but it's hard considering, especially in some of these more expensive markets. It's venture capital, which is almost impossible for the average person to make money with. Your Peter Thiel, these kind of guys. And then it's just traditional stock investing, right? The Warren Buffetts, the Charlie Mungers, the Ray Dalio, Peter Lynch, these kind of people, right? Those are the most successful people, right? I mean, if you go to like the first thing you think of when you hear successful investor, the average person, like nobody's thinking of a day trader, right? Nobody's thinking of a crypto trader, right? Again, I'm bullish on Bitcoin specifically, but day trading it in my mind is stupid, right? Because, and this is the thing, I'm not saying there isn't successful day traders. There is for sure. The problem is replicating the process is a lot harder than simply buying good companies and just dollar cost averaging over a period of 10, 20, 30 years, right? If you simply buy good companies over a long period of time, you will do well, right? You will do well. And what do I mean by that? I mean companies that, again, they're not overly expensive. And again, what's expensive in one sector or one area may not be expensive in another area, right? I mean, a PE of 25 in the tech sector is pretty average, right? But a PE in 25 in the utility sector or consumer staples, yeah, that's going to be pretty expensive. So that's another thing you need to do your own due diligence, right? Um, so that's the point, right? What else is good? Companies that are growing not only earnings but cash flow, right? Because growing earnings can be manipulated, right? Even revenue, right? Is that revenue being converted to actual cash on the balance sheet? Is that actually turning into more profit? Right? Because a lot of companies, yeah, they're growing, but are they growing the underlying profitability? Right? Do they have a lot of debt too? This is another thing you need to keep an eye out for, is that a lot of these companies are growing specifically based on some form of debt. Are they issuing new shares? Right? So again, what you want in a good company is they're very profitable. Ideally, they have some sort of a moat. They're growing their profitability numbers. They're not issuing shares. If they have a dividend, they're growing that dividend. The payout ratio isn't unnecessarily high. And on top of that, I think another important thing is that the company actually produces things that we really, really need, right? Because a lot of these companies, like I say, the tattooed chefs of the world, the Pelotons of the world, like this is stuff that at the end of the day we don't really need, right? This is why I think that oil is going to do really well over the next decade or two. A lot of these materials companies, a lot of these industrial companies, like think of a CN, right? That's a company that the demand is going to stay, and it's almost impossible to for any new competitors to pop up. I mean, there's CP, but again, that's an example of a good company. Again, you're not going to get rich off it, but it's an example of a good company, right? Waste Management is another company that's done very well over the last decade or two. Again, a company that is going to grow, right? It's not gonna make you rich, but it will probably keep up with the market, and it'll do it in a safer manner, right? Again, I'm not, do your own due diligence and all that stuff. I'm simply saying that, again, blindly indexing has done pretty well. Like buying a lot of these frothy companies like the Teslas of the world, the AMDs and these kind of, like, it's worked out amazing over the last decade, but it probably will not work out very well over the next decade or two, because again, if we have a higher rate environment, these companies that have very low earnings yields are not going to do well, right? And that's another thing that people need to keep in mind. The companies that can generate the most amount of returns, or bring the most amount of value for investors, are the companies that are going to do the best, right? These high growth, frothy companies, they're not going to do as well. And again, not all of them. Some of them will do well, but not all of them, right? So again, I just wanted to bring this up because I think people are going to continue to learn this lesson the hard way over the next decade or so. So anyway, that's what I wanted to bring up today. Hit that like and subscribe if you haven't already, and stay tuned for more.